We're going to get started now because we want to get you out before midnight. And truly, this topic is something that can go to midnight. I have no idea how to turn that music off, but if anybody knows how to do that, go ahead and try that. Anyways, I'm so pleased that you're out, especially given the weather, but we'll make sure that you're warm in here and that there is plenty of wine and plenty to eat and dessert and everything else. You know, for all of you that have been here before, you know the washrooms are over there, so just get up and go anytime. Help yourself to more food. We love it when we don't have any leftovers. We're pleased to be here today to be able to talk to you about a topic that I think is really important, and that's all about investing. As you know, at Zavitz Insurance, we don't do that. We don't do investments. But I get to see so many of the reports. I get to hear so many questions that you ask of me. And I realize that it's a topic that's important to you. And I get the privilege of hearing from great investment advisors like Vic and with Paul, and from people like that, I start to understand the investment industry. And as I told a lot of you before, I thought it was so interesting, I thought I would take my, my securities course this year, or last year in 2014, and Justine did it with me. And it was an amazing course. I'd encourage any of you to take it. There's actually a course online that you can take with the securities group. So if you're so interested, I urge you to take it. It was very, very good. So it was terrific to be able to ask both Vic and Paul to come tonight and to be able to talk about investing and just give you the straight goods. And so during this time, the only rules that we've got is that you're to go and get more food when you need it and ask questions. And whether it's myself or whether it's Vic or whether it's Paul, we don't mind any question you ask because we're here to make sure that you understand the investment industry. Rather than introduce everybody, though, I put the bios into the packages that are there. You can see that everyone's been in this business for quite a long time, and so a lot of expertise here. And then what can I say? We've got Lynn with us today. And we had Lynn with us last year when we did that, and I've known Lynn for such a long period of time. I think a lot of you know Lynn with her career at MD Management, and then of course as she moved to a different role, and that is as a professor at Fanshawe in the Financial Services Program. And that's a program which I personally think a lot of. Justine graduated from there, and from that point in time, every new hire we've had has been a graduate of the Financial Services Program. We just find that their graduates are very much in the know. Lynn has a lot to do with that, and her character is all over it. So I was so thrilled that she was able to come tonight and act as our MC as we go through all these different questions. So what we're going to talk about tonight is how do you know if your portfolio is appropriate? What's happening in the securities market? There's some big changes that are happening in 2016 you need to know about. It'll affect you. How are advisors compensated? You should know that because it affects your returns. How does licensing work? What do designations mean? So we'll bring that right out. So we've done it in a format of which we've got a number of questions, and we'll answer the questions between us, and we've got a number of slides to work around it. We'll invite your questions, but don't be insulted if Lynn cuts you off because, again, we're trying to keep on a timeline. We'll make sure that that timeline begins. On your table, though, in that package, besides the buyout, is a copy of the seminar. And you've got pens on the table, so feel free to write notes. Also, too, we'll be referring to some of the articles, and I just felt that they were interesting articles. I put them together, and because I'm a lay investor, I went to the most knowledgeable source on the internet, and that would be Motley Fool and Couch Potato. And so those are the types of, yeah, they're not the technical ones. They're the ones that are really easy for people like myself to understand. So I figured that you might find them very enjoyable as well. So with that, Lynn, I'm passing it over to you, and away we go.
Thanks, Terry. She reads Motley Fool and Couch Potato, but she takes the Canadian Securities course, so don't take her. I'm really pleased to be here, and I can't wait to tell my students that people come out to listen to the stuff that they have to do in class that they think is boring and nobody cares about. So it actually is of interest. And my main job is to keep us on time, and we're already a few minutes behind, so I'll just do my best to keep us at an early schedule. But I'm going to start off with the first question, which is, how do I know my investments are right for me? Most of us like it when they go up and they feel right, and when they go down, they really feel wrong. But how do we know if it's really right or not? And we'll start with Vic.
All right, so that's a great question. No one has to put their hands up right now, but interestingly, I'll bet there's somebody in this room that does not actually have a written financial plan. And there must be somebody up there like that. And interestingly, TD Bank a couple of years ago did a survey, and they asked Canadians how much time that they spent in the year, over 365 days, working on their financial plan. Anybody want to guess how much time the average Canadian has spent working on their financial plan, generally?
Half an hour?
About 4 minutes.
That's what I was going to guess.
It's true though, even half an hour would be really, really great, but it's actually, it was actually tracked out to be a best guess about 4 minutes. And it happens for many Canadians right around about 7:30, 8:30 p.m. on Friday, February the 28th, when they're running in to drop their RSP check off to somebody to say, can you please put this to work? And you know, it's an interesting statistic. And you know, before we just get into the plan over here, we've got 35 million people living in Canada. And out of those 35 million people, we could probably count honestly on our fingertips those people that actually have a written plan, or at least an idea in their head of where they're going. Of the 35 million Canadians, 20 million of us have zero saved for retirement. Not one nickel saved. We're talking negative equity. Of the 15 million Canadians that have saved, who are the median age right now of 58 years of age, any guess of how much the total retirement is between RSPs, tax-free savings account, like median account balance?
$250,000?
Okay, good guess.
100,000.
Also good guess. Real answer, $24,000.
Yeah.
Serious. It's 24,000 bucks. That is what the median 58-year-old of the 15 million that I'm saying have saved. So whether it's Terry, Paul, myself, or any of your current advisors, when you go in and you say, I'd like a plan for my $24,000, I mean, we don't laugh. I mean, it's real, right? Like this is the dilemma facing us. So for those of you that haven't started planning yet, and certainly from today, a big question that we get into with how do we build a plan is, well, what do you have to work with? Let's start with that, and then start to build from there. And those people that do have $250,000 or $2.5 million have very different, I guess you could say planning, but the plan all comes back down, and Paul's going to talk about it deeper as we go further in this. What do you need to live? Some people are going to be very, very comfortable on $1,500 to $2,000 a month to live. Some people need $20,000 a month to get through the month. And those are real numbers. So the plan has to be focused around what do you need to live as opposed to what is my rate of return. And further to that, you get into things like what is risk tolerance? How do I pay down my debt? How fast should I pay down my mortgage versus investing in my corporation? All of these things that apply to your world are actually what a financial plan is. It is not just should we invest in Canada, the United States, or Botswana diamond mines today, right? It's really, really a very holistic approach. And coming out of today's session, a big part of it will be trying to understand the value of the advice that you get should be customized to you and not just a cookie cutter couch potato strategy that applies to all.
So do you want to talk about the risk tolerance?
Yes, the risk tolerance asset pyramid. This is just one of those things, just in a very, very, it applies to most people. At the base of it, you want to make sure that whether it's bonds, debt management is a big thing when you're starting in life, but going through life, getting to the safe and fixed income kind of stuff. What's not in here, and a big thing that we always encourage, is have a line of credit. It could be on your house, it could be an unsecured or a secured line of credit. Have a safety net with you that you know that you've always got something. If the roof starts leaking, you've got some money that you can dip into and you don't have to cash in your RSP to do it. Going up from there, of course, for a lot of Canadians, they move into real estate, and that's primarily, again, a lot of home equity that's tied up with a lot of our net worth. But remember, one thing that we talked about in that, don't treat your house as a retirement asset. You have to live somewhere. For a lot of people, they may downsize, but they're going to use that home equity for something else. So if your house is worth $500,000, that's not necessarily $500,000 to retire off of. mutual funds, stocks, things like that, but things that are, again, a little bit more volatile. And you get into the fun stuff up there, which is the stuff that people love to talk about. The media likes to report on it. Should I buy or sell or short oil today? Is gold the right time to buy that? Pork bellies, are they the best option, and things like that for your retirement plan? It's all the high risk stuff. If you inverted this entire pyramid and tried to build your financial life on it, that's when you start having the risk toppling this way or that way. So always encouraging to build it accordingly. And if we flip over one more slide, Terry did some really great math, actually. And this is a TZ chart here.
And I checked your math, and it's good.
We were very impressed. How you earn your income, and a bigger part of this is taxation. For those of you that may or may not own a corporation or a small business in Canada, or again, those of you who are investing any money of any kind, how you pay taxes on your salary or your dividends makes a huge difference, because of course it's what you're left with. The higher you go up on the income scale, it's so interesting to see how you earn dividends, interest, eligible dividends, or capital gains. The 4 different ways of earning money change so much. And what was interesting for all of us, if you're making, I'll use this example here, the $220,000. $220,000, the best way to earn income for you is going to be in the form of capital gains, which is about 25% tax, versus dividends, which is taxed at 40%. That's the high income earners. The people that are in the lower bracket, the best way for you to earn dividends is eligible dividends. So if you're paying your kids or paying a spouse or vice versa from, again, your corporation, or you're earning dividends, again, from a stock, you're paying much lesser tax. Key takeaway from this, take a good look with your tax professional or your advisory team of how are your investments structured and how are you compensating yourself and making sure that you're optimizing it. Yeah, question?
What's the difference between dividends and eligible dividends?
You want me to try that?
Yeah.
I can do that. Corporations pay dividends out of their after-tax profits. And the really rough rule of thumb would be a public company, like you would invest in on the stock exchange, is probably paying you eligible dividends, meaning they're eligible for a higher dividend tax credit. Their tax rate is lower. Other than eligible dividends, which is the real term, come from usually from your private corporations, small business corporations, corporations that are eligible for what's called a small business rate, small business deduction on their earnings. So most people's private corporations are in that category. The dividends they pay out are taxed a little heavier, the ultimate. That's the bottom line. So we would define it very loosely as public corporations versus your private corporations, eligible dividends, lower tax rate. And the reason for that is that the corporation itself paid a higher tax rate. The other than eligible dividends, the corporation's earning and paying at a lower corporate tax rate, so the dividends coming out to the person get taxed higher. In the end, it's all taxed the same, and that's how they do it. Does that make sense?
The part that I really wanted to emphasize on this slide was just the impact of how your investments receive income. And it's important for you, but it's important for your children as well. Because if we look at somebody who decides to take a salary of $220,000, I mean, last year the dividend rate wasn't over 40% for dividends. What was it, Vic? About
It was 37.
37, 36.
Yeah.
But now it's over 40% for the taxation of dividends. That's how much it's actually gone down. So salary has turned out to be a whole lot better way of taking money than dividends this year. But at the same time, we take a look at somebody whose income is, let's say, at 41,000. It's just under 41,000, which could be any one of our kids. It turns out that if they had stocks that had dividends paid by public corporations, which are called, for the most part, eligible dividends, the tax rate is actually in the negative. It's negative 6.85%. So if that same child has capital gains are actually taxed at 10.03. They're the worst investments for somebody to have when their income is under 41,000. Eligible dividends are the best. If you're in the high tax bracket, capital gains is the best thing that you should have. So there's no specific rule of thumb when it comes to taxation of investments and whether you should take dividends or salary. So I pass it to Paul.
So I guess I have the topic here of investment policy statement, and I'll go back to the very first question on the first slide, which was, how do I know if my investments are right for me? The investment policy statement really is the gauge to determine whether you're getting the right types of investments and being reported on the right way and paying the right type of cost. In terms of the specifics, it's some of the obvious things that need to be in there. The account, the size of the account in terms of the dollars that are being discussed. The long and short-term investment objectives in terms of what is this money for. The timelines and risk tolerance. Now, risk tolerance is funny because in a high-level investment policy statement, it will talk about how much are you willing to live with in terms of a drawdown on your account. And that gets into very emotional type of discussions as to what is your worst case scenario and what can you handle that the market is for sure going to deliver at some point. So it really gets into a conversation between the advisor and the client as to what is a good plan for the long term. Specifically, it can get into obviously how much it should be in cash at all times, how much should be in the fixed income and stocks as well as real estate, etc. And sometimes the investment policy statement will just deal with whatever account that advisor has, or it can encompass other assets that are held by the individual as well. I will say that a lot of people, in terms of individual investors, might have an investment policy statement that they don't remember really talking about, because we have one for most of our clients. And it's very important for us because it allows us, as we set out those limits, if it's 50% fixed income, 50% equity, in those extreme times in the market, like 2008, 2000, 2011 even, when those weightings get out of those ranges, and we make those phone calls that say, you're now out of your policy range, we need to sell what's been going up and buy what's been going down. And most times people will say, well, that sounds crazy, why would you do that? And then we say, well, there's an investment policy statement that we talked about and your level of comfort with risk. And this is what we need to do because of that, or we need to go over this whole risk assessment process again to see if there's a change that needs to be made. And our goal is always providing the peace of mind, and this really does, over time, provide the peace of mind. Now, it doesn't have to be complicated. I have one from our largest client, sort of a 9-figure account, and it's only 4 pages long. So it really can be quite basic, but it does trigger the conversation that needs to happen so that you can look back and say, okay, have I got the right investments at the right cost from the right person and firm? So that gets into sort of a key part of the investment policy statement is obviously the underlying holdings that are in there, and oftentimes the risk that we're talking about is the stock market risk. Most times it's more exciting and fun to talk about the stock market returns, but it comes with a level of risk as well that we have to appreciate. So you can see there's always something for the market to worry about, and I was saying to Vic and Terry that we have this great video that shows all the time covers from, I think it's back to 1930 up till present day, and you see kind of what the world was worried about at any different time, and you can look at those almost as a contrarian indicator, because the North America, well, the global system has a way of always progressing and finding a way to earn more on the same level and grow over time. But there's going to be times when the market challenges you to either, feel like you need to get out for a period of time, or, rush in at possibly the wrong time. There's another key thing that's not talked about here, which is fixed income and the interest rates that we can get right now. And we talked about how interest income is taxed the highest, and right now it has the lowest yield or the lowest expected return Plus, arguably, it might have the most risk right now, because as soon as interest rates go up, the value of those current fixed income holdings will go down. So there's a lot of discussion right now as to the target rate of return that should be discussed between a client and their advisor. You know, what does this money have to achieve? Will 5% do it? Will 6% do it? And if those are the types of rates of return, how are we going to get that? Well, we only get 2% from a 5-year GIC. So you really have to talk about the ingredients to that plan and what you can expect over time. And we'll talk about this again, because really it does come up in so many of the other conversations and slides here, in that an advisor helps you with those ups and downs.
I'll say too that on my very good site, the Couch Potato and so on, they had a really good article, and I put it in your folder. And it was all about normal stock returns. And so in this folder, you'll see the normal stock returns, and what they did is they looked at the developed world up until June of 2012, over many, many, many years, and they determined that the average the rate of return over all of those years was 8.5%. That was over 112 years in the developed world, 8.5%. So the midpoint that's the midpoint between 6% and 11%. So what they did in the Couch Potato is they actually looked at all the rates of return since 1964. And then they said whether it was higher or lower than those rates. And if you look at that Couch Potato, you can see that it rarely was 8.5%. It was either higher or lower. And really, it's a dog's breakfast as to where it turns out. So what does that tell you? You couldn't possibly have anybody that could go into a crystal ball and tell you what the market is going to do next year. You just couldn't possibly. You'd have to get into the head of Putin. You'd have to get into the head of Saudi Arabia, who decided that they didn't want any competition, right? You'd have to get into the head of all of these people to understand that, and nobody could really do that. So the most important part is that what is that risk tolerance? What are you prepared to risk? What is your taxation rate? Where are you going to be? And then what Paul says is that have a statement that actually outlines what your expectations are, and then you have the advisor that is constantly keeping you on track. And that's what your advisor is there for, to keep you on track, because the markets are going to go up and down like a yo-yo. They always have. It'll never end. And just to go to Paul's point about keeping you on track, I can always remember a very good insurance client, a terrible investment client, I'm sure, to whoever was his investment guy, because he was very, very conservative, and he kept telling me, I only want a 5% rate of return, and fixed income is my thing, and all that sort of thing. And he would just tell me. And so, I saw him and I said, okay, so, how you doing? Oh, great, you wouldn't believe how I did on the market last year. I said, really? You're in fixed income? He says, I did 17%. I said, well, what are you into? You couldn't possibly have done 17% into fixed income. And it was everything but fixed income, but he had decided to take over himself and buy his bonds online. Well, I don't know what bonds he's buying. I think they're Greek.
So the next slide talks a little about benchmarking, and I would say, again, going back to my simple investment policy statement, it can be as simple as, here's my rate of return that I need to pay my kids' education, to buy a cottage, to do all those things. Sometimes, and Vic and I are on a investment committee board together, and we have a benchmark to gauge whether those managers that we've hired are doing a good job in each of their areas. So that's very different than an individual that really is trying to generate a return to pay for an objective. This is a case where it's a perpetual fund that's supposed to help, the needy of London forever. So, but the benchmarking allows us to gauge whether somebody's doing a good job in the short term, but what we have is a target rate of return, just like an individual does, that says, here's how much our costs are, here's how much we like to give every year, so here's the rate of return we need, and we do our best to generate that return within a given level of risk. the benchmarking comes back to using your advisor to pick the right benchmark so that you know what you're gauging your investment performance against. I would say that it's kind of used too often because most investors don't actually get that type of benchmark return anyways, because there's always ins and outs and that sort of thing. So I think it does come back to have the unique plan that works for you and your own objectives with an advisor that you trust and who comes with a reasonable cost.
Can I just point out some very simple math based on this? They mentioned maybe 8.5 is a long run average of the stock market, and 2 maybe, if you're lucky, on your fixed income. That means if you're a balanced investor, 50-50, 50% in stocks, 50% in bonds, your average return would be 5.25. On the other hand, you're never going to see the average. It's rarely going to be the average because the stock market will make it higher or lower, and the bond market as well will make it higher or lower. So we always have these years where we feel great and these years where we feel awful. But 5.25 before inflation isn't a really high return to be counting on to make your retirement work out. Now I'll go back to moderating. The next question is to do with choosing an investment advisor and understanding the expertise of your investment advisor. And if you go to the next slide, there's a few regulatory bodies and designations. And I'm going to explain very quickly the regulatory structure in Canada because it's a pretty newsworthy topic these days, but also the professional designations. So there's really 2 things going on. How are we regulated and licensed? And then what are we doing professionally to build our expertise to deal with our clients? So in Canada, we have provincial regulation. You've probably heard of the Ontario Securities Commission. That's the big boss in Ontario, and there's a comparable body in every province and territory. They come together with a representative each for the Canadian Securities Administrators, and that's who's trying to make policy for all of Canada. We have problems that we don't have a consistent Canada-wide policy. So that's what the CSA is trying to do. These government regulatory bodies delegate their power to self-regulatory bodies, and that's where we get IROC, which is our regulatory body in the Investment Industry Regulatory Organization of Canada. We just call it IROC. And so you might have an advisor who's licensed with IROC. Probably, I would say, you would. An advisor might also instead be registered with the Mutual Fund Dealers Association. That person's going to be limited to advising on mutual funds, not the full range of securities. Possibly you have a portfolio manager who's licensed directly through the OSC. But most of you're going to be dealing with IROC. And IROC's a little bit of a thorn in everybody's side right now because they're coming down with huge changes in how people need to conduct their business, and we'll get to that. But to be in the business advising people on products to buy, you have to be, in the investment world, you have to be licensed. A lot of the scams you hear about, you know, every once in a while someone jumps into town and takes away a bunch of money. They're usually not licensed people. It would be a pretty easy check to find out that they're not actually licensed with anybody. So that's the licensing side. Then you have people trying to build their professional credentials, their ability to advise and understand and really serve you well. And I looked at this list today, and then I went on the IROC site. And the IROC site has a document that prints out as 40 pages listing the different professional designations that people have who are advising clients on their investments. 50. So one that we all share, I believe, is the Certified Financial Planner. And that takes a few good years to get that Certified Financial Planner. It's always a thrill when I hear one of my former students has achieved that. But it's still a beginner financial planner designation. You see CFA, that's a Chartered Financial Analyst. That's somebody who's done a lot of extra work in understanding how to analyze securities and select them and build a portfolio. That's a very difficult designation to achieve. If you see someone with their CFA, you should be impressed. Okay? Do we have any CFAs here? Without going through all of them, a lot of them are very specialized. There's a divorce consultant, there's a retirement consultant, there's consultants for aging and the elderly and it's other, slight things. And then there's lots who overlap. But they go on and on and on. And if you do want to know what the letters mean on your advisor's card, you just have to go on the IROC site and get their list, and you can read all about it. So that's the intro. How do I know if my advisor is doing a good job? And let's say having some designations is a nice indication that, because you don't put your licensing on your business card. We assume that. Your designations mean you're trying, right? It doesn't mean, not every designation is a great designation. Some of them are pretty short, easy courses, to be perfectly honest. But the main ones are pretty impressive. If someone's building a portfolio of designations, they're trying hard to build their expertise. But beyond that, let's go with, who wants to answer? How do I know if my investor's doing a good job?
So interesting story. So back in July of 2014, had a call from a client named Mary. Mary's been a client for 16 years. Fantastic plan, going along, doing her thing. We were 4 months from retirement. Everything has gone as perfectly clockwork as we could imagine. Get the call. Vic, I got to come in for a meeting. Came in for the meeting. What's up? We're doing excited about retirement. Very excited, except I'm leaving you. I'm like, well, why? My son just passed his license. Right? And I've got to support my baby boy. This is a client that has assets of $1.7 million, and her son passed the exam successfully.
So did I.
Yep. 9 days before our meeting. And we gave each other a hug. She shed a tear, and I said, door's always open, and I wish you well, and off she went, and so forth. And then, and I've known her son for all those years because, I mean, growing up in the relationship for the last 16 years, I've known him. There's many advisors that are there that are strictly there, unfortunately, to make a product sale. And we must recognize, as when you're doing your due diligence out there and so forth, what the difference is, again, as Lynn said, between licensing and product sale versus, again, proper portfolio advice and financial planning as an advisor in some capacity. Again, there's so many different investment products and services that you can pick from. If we tried to actually make the list, it'd probably get into 500 pages of what all the different things that you'll pick from. And marketing is an amazing thing out there because you'll see billboards and magazines and Globe and Mail articles on what is the flavor of the day and why you want to be in it. And we all get the calls for it, and it comes back down to, again, the investment policy, what's your risk tolerance, understanding and asking those questions from a trusted person that's in your life or an advisory team in your life to help you navigate through what all those differences are. Talking about, again, institutional advisors versus independent advisors. Whether you're with a large bank-owned brokerage or you're at the branch level dealing with your planning, or with an independent, whatever the case may be, it's all about, again, the level of advice that's working and right for you. And as long as you understand your fees, your products, what are all the different metrics that come into building it for you, you're going to be great. It'll really work out. But don't just go with a off-the-shelf cookie-cutter approach, because one size does not fit all in your world of planning.
I just want to know, how did that lady do?
Well, it's really interesting. That was July. It took about 3 months to move her account because her son didn't know what forms to fill out. So we were helping him along with that, and then he called in near December asking for some portfolio advice based on a slide of oil. And he had loaded his mom up a little bit too much of commodities, and he was a little bit worried about talking to her over Christmas dinner. So he wondered how my conversations have gone with her the previous 16 years.
Oh dear.
So, she'll be fine.
You know, it's interesting because what I get to see is I get to have these really heart-to-heart conversations with so many people with regards to their investment, because they can talk to me. I don't do it, and so therefore they can talk to me what's going on, and I'm always quite surprised when I get what I think to be a very rational person, at least I find them rational with insurance, talking to me about something that I think is totally irrational. And so, you know, how, as politely as possible, you know, you ask for, maybe they should go for a second opinion. Anyways, going to one of my awesome websites, Motley Fool, I came up with Investing with the Stars. This was a true story. I have seen it before. And so Motley Fool decided to write about it, tongue-in-cheek. And the idea behind it is that we should all plan our investments according to the astrology, and that we should determine on whether it's Uranus or Pluto or who's passing the moon at what point in time as to how we should invest. Now, when you read this article, you may say, you gotta be kidding me. Like, people can't honestly be doing this. Well, I tell you, I have seen people do this. I've seen people where they have come in and they have said, just read a book. And that starts me off going, okay, just read a book, and I'm going to go and call this investment advisor because what he said is you should be investing according to the seasons. You should be moving your investments out just before summer and then coming back in about October, and then he proceeds to show you why this is a really good idea, and so that's what, you know, you're gonna do. I just think it sounds like a good summer holiday to me if I was the investment advisor, but you know, this is the type of thing that you see. So I think that you have to look for how are they licensed, what kind of designations do they have, what expertise do they have in very particular areas, and then you'll be able to judge and not try to be swayed by who wrote the book on what fancy idea moving forward.
I agree. I would just add, in terms of the designations, that if somebody doesn't have any designation, it is a good indicator that they don't really take the profession, I'll call it, seriously, because I would say all the firms are all embracing it. They pay for it. You know, it really is a first level filter as to whether you have a professional advisor or not. I would go back to, again, answering the question comes back to the things that could be in an investment policy statement. If your advisor is doing a good job, you're going to know because they'll call you, because it can be in the investment policy statement, you know, quarterly reviews of the portfolio, annual meetings to see if my financial plan has changed, my job has changed, you know, grandkids, whatever it is. Because of the regulatory environment that we are in, we have to get new accounts documents signed every 2 years to make sure that all the financial information is updated. So if you're not having those regular contacts, which involve the performance plus a whole bunch of other financial elements, then I would say that you have a good indication that your advisor maybe isn't focused on your portfolio sort of thing. There should be clear communication as well that what your fees are and how you're paying them, and are you able to deduct them and that sort of thing. So that can all be in this investment policy statement that will allow you to check off the boxes each and every year to say, okay, did I get what they said that they were going to provide?
I'm going to add a comment here. I think that, believe it or not, it's a good thing if your investment advisor is a little bit boring, because it shows that they're disciplined and they stick with the plan and they go along. They're not in there trying to make something different every time, trying to attract you with some new razzle-dazzle. And I'll tell you a true story coming out of what Terry was talking about. When I started in the industry, I was pretty serious and I was trying to learn about asset allocation and how to properly manage a portfolio. And someone who worked in my office came to me and he said, Lynn, what you don't understand is we are in the entertainment business. How would you like that as a client, to think that we regarded ourselves as being in the entertainment business? And there's too many out there who do feel that pressure to keep you entertained and feeling great about your investors. And that's not necessarily going to be the best thing for your money in the long term. You would agree with that? Yes? Okay. So we'll move, we can take questions on these things, but we are a little bit behind time, and I know some people will want to leave. So I think what we'll do is, if you have questions, do catch my eye, but otherwise we'll leave it till after, and then those who want to leave can go, and those who want to stay and ask questions can do that. But compensation's a really big issue right now. And that's because the IROC rules are forcing everybody to be way more upfront about exactly how they charge you and exactly how much you pay. Not 2%, how many dollars. So this is a big change coming with the what we call CRM. But Vic, why don't you start with all the ways that we get paid in the industry?
Absolutely. Well, it's a really, really funny conversation. I mean, for many of us, within the first 5 or 10 minutes we sit with a client, the first thing we talk about is, let me tell you how we get paid. It's the first starting point. And if you have not asked your existing advisor or advisory relationship, what is the fee model, then we encourage you to start that conversation immediately. So there's a whole myriad of things. Again, we've just kind of highlighted some of the key ones, but transactional fees, we'll start with that one. You could be paying $6.95 to do a trade online. You could be paying 1 or 2% of the trade, which could amount to $300 to do that same exact transaction. So be aware of what that transaction fee is when you buy, sell a stock, a mutual fund, a portfolio, anything along the way, a bond. There are often transaction fees associated with it. Understand what they are and what they could be. For a great many Canadians, they have mutual funds, and inside a mutual fund is something called a MER, which stands for a Management Expense Ratio. And it is the total all-in fee that you pay from what you make. So if the gross rate of return was 10%, and the MER is 2%, you will take home 8%. And from that 2%, there's usually 2 components. There's the fee to operate your actual fund. That's charged by the portfolio manager, the mutual fund company, the reporting, all the things to run it actually. And then the other aspect of it is something called a trailer fee, which is what is paid to your advisor to help offer and assist you with your advice. So that's an MER, very common. Front-end loads, back-end loads, and no loads. This is a big thing. One of the major reasons why the world is changing on January the 1st, 2016 is because a great many Canadians have been put into products, knowingly or unknowingly, are back-end loaded mutual funds or portfolio funds. What that means typically is that when you make your investment, let's call it $100,000, your advisor was paid 5% or $5,000 of commission. You are now married to that mutual fund or that fund family for typically 7 to 8 years. And if you leave the next day, you pay the $5,000, your advisor keeps the $5,000. And that sucks for you, the investor, that wants to leave that portfolio. That back-end load starts to slide off for 4.5, 4, 3.5, 3, down to 0. But what's happened, of course, in our industry, unfortunately, a great many people have said, oh, there's only 1%, and this is about to mature or expire. Let's relock it in for another 7 or 8 years to create a new, fresh 5% commission. It's a horrible thing that's happened, but things like that are what are propagating all of this change with this new CRM2. So be aware of what these back-end loads are. If you have them, they do expire. There's ways to get out of them. Front-end load means you pay a fee anywhere from 0 to 5% to acquire your investment. You can negotiate it down to 0 in many cases. And no load means you pay nothing to acquire, you pay nothing to sell it. It's a commissionless transaction in or out. Embedded fees, investment management fees, IMFs, are simply what is the pure cost of managing your fund, and then you pay for advice on top of that. So now there's a little bit more of a, let's break it apart. And there'll be a little bit more discussion on the taxation differences between setting it up in different ways. Trustee fees, it's common for many institutions to charge somewhere in the nature of $100 to $150 per account per year for having an account open. So in some cases, some institutions will charge you $500, $600, $700 if you have 5, 6, 7 different accounts open. Sometimes those fees can be waived, sometimes those fees are not charged, but be aware of what a trustee fee is if it's applicable to your account. And fee-based investing is something that's on the rise, although it's certainly not common right now in Canada, but we think it's an awesome way to, for you to kind of partner with your advisor or advisory firm. And that's by saying, look, we'll pay a percentage of our total assets under administration. The better the account does, the better the fee. If the account goes down in value, the advisor and the advisory firm takes a pay cut. So there's a little bit more alignment to how to, again, manage and grow your wealth. No? Yep. And then this page is just talking about why fees matter.
Oh, sorry, I missed it.
No, it's all right. No, right there. You may not think that 1% makes a big difference, but it makes a huge difference when we're talking about 10, 20, 30, 40 years of time. And again, a great example is, again, the total return for the last, from December 2004 to 2014, so that 10-year period of time, if you made 8%, you've grown your money net of the fee to $196,000. If you're paying a 2% fee, you're down to $179,000. If you're paying a 3.5% fee, you're down to $155,000. That's $40,000 of real money, your money, that's going out in fees. And none of us are suggesting that not paying that fee is necessarily the best financial move for you. What we're suggesting is be aware of the fee you're paying and understand is there something that could be in a lower fee that's going to help get you there, because a 3.5% fee is a really tough investment hurdle to make. If you're trying to make, as Terry rightly said, 7 or 8%, when she referenced 8.5%, that was the total rate of return that the market did. That was assuming no transactions, no advice, no reporting, no nothing. That is just the gross fee. So if you're paying 3.5, now all of a sudden you're down to 5 versus 4 versus whatever. So be very, very mindful of it, because fees are a major, major, I guess, detractor to net rate of return.
It's a hard topic because a lot of people have that phrase, you get what you pay for. There's probably, the high end is probably not warranted, but on the other hand, going too low, you wind up losing the professional services and protections that you need. So there is probably a sweet spot, and we don't know where it is. The CRM, how many of you heard of the CRM? Everybody, anybody? People in the industry? It's, this is IROC initiative backed by the Canadian Securities Administrators going forward with reforms, and the Mutual Fund Dealers Association has announced that they will take on similar format for themselves. And the purpose, my take on this, and you may disagree because remember, I'm not in the industry anymore, but IROC will say, you know what, 40% of our complaints that we moderate are based on suitability. What this means is that clients have made a formal complaint, meaning they've already gone to their advisor, they've already gone to the advisor's firm, and now they're in IROC, complaining and saying, these investments were not suitable for me, and I should be compensated or reimbursed for what I've lost because the investments weren't suitable. My advisor should never have had me there. So I thought it was interesting when Paul said, you know, the clients don't really remember signing the investment policy statement. They sure don't remember click, 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 click in the new account application form, which is where they're assigning suitability without really knowing what it's about. So CRM is telling advisors, you better talk with clients about what this means, and they better sign saying that they understand what it means, and you better tell them how often you're going to review it, which is often, and all the other ramifications of it. So that's the first phase, and the second phase is to be very clear about how much fees are and what the performance report or what the performance is of your money. In the beginning part, CRM phase 1, you have to tell them how you're going to be paid. CRM 2, you have to tell them how much exactly. The systems are a problem for most firms, just coming up with how will we do that. It's not that they don't want to or aren't willing to, they just don't know how to do it. It's very complicated. But having given that introduction, Paul, I think you had some comments about how it's affecting your life.
I would say in terms of our practice, you know, phase number 1 is what all reasonable or high-level advisors already do. So that's not anything that, it's almost a shame that that had to be mandated as a rule because that's just general good business practice. I would say it hasn't really, for that reason, it hasn't really affected our business in that, but it has affected our firm. And you're right, it is a technology issue because all these financial firms have very complicated technology systems, and to just overlay one new thing that seems very basic is very hard to implement. And our firm has been very open about trying to get the 1,000 advisors that work at our firm operating in this type of environment to be ready for it. And then we trust them that they're going to figure out the technology at some point. Mm-hmm. But we view this as a competitive advantage because we already operate this way, and a lot of good advisors, and we sort of know the advisors in the area that operate a certain way and ones that might not necessarily operate that way. But the key thing is that every client at the end of every year will get at least 2 new things that they may already get, but they're going to for sure get. And one is the rate of return. A lot of advisors just rely on the monthly statements generated by their firm to communicate with the client as to what their portfolio is. We've always provided a snapshot, at least quarterly, that shows what the rate of return is. So that, again, to me, that's basic business practice. The second piece at the end of every year is going to be a total dollar fees paid, which I think is going to open a lot of eyes. The fee example of 3.5%, you know, if I ever thought that my parents or if something, God forbid, happened to me and my parents ended up paying 3.5% somewhere, I would roll over in my grave, I think.
Yeah.
But it's amazing how many people are out there paying that and don't realize it. So if you have a $1 million account, you're going to get a bill effectively that says your advisor and his or her firm made $35,000 last year that wasn't in your pocket. You're going to then ask, okay, I'm going to check some boxes. Did they call me? Hopefully. Did they deliver decent performance? Yes. Did they do a financial plan? Again, hopefully. Can I get a hold of them? You know, are they primarily voicemail? Are they gone for the summer? So there's going to be a lot of questions asked that I think bring the level of our profession up a notch, which I think everyone is on board for. What's happened, this has been rolled out in different forms, but generally the same spirit in Australia and the UK. And what happened was the number of advisors definitely went down. There's conflicting reports. Some people say that the number of advisors licensed went down by 20%, but then there's others that say it didn't quite go down that much. But what we know is that advisors that couldn't provide those things either teamed up with somebody that could, or they just retired and sold their business to somebody, but it definitely changed things. And I think at the end of the day, you have to think that those ones that left or are no longer practicing were, you know, the worst part of the business.
These things have happened in other professions. You know, it used to be that a college teacher would come in and just be philosophical about their time in the business and chit-chat away their term. Now they have to have lesson plans and a course information sheet and run by it. Doctors didn't used to have to do notes and keep charts the way they do today. Everything has, the standard of recording and reporting has gone up in every single profession. But this is the time for the investment industry. And there's going to be some shock, I think. Some are taking fees that aren't known to their clients, and it is going to be a shock.
Whenever we do plans for people, I will often say, you know, just tell me what's in your portfolios and tell me what the rate of returns are. And I'll get those, and I can do a plan off of that, but then I'll often just say out of interest, you know, do you know what you're paying your advisor? And it's very rare that I find people that actually know what they're paying their advisor. And so that in itself, you may have an advisor actually that's actually doing a really good job, and you're paying him or her appropriately, but you don't know how you're paying them, and I think it's a very good idea to get that, to know that. And I will tell you that what I like to see is somebody says, yes, I know what I'm paying my advisor. I'm paying them this percentage. And let's just say as an example, 1.5%. It is possible that, let's say you had $500,000 to invest, it is possible that your advisor can set it up so that you pay that 1.5% to the advisor out of your pocket. And that 1.5% is deductible on your income tax returns. Well, as long as it's not an RRSP, it's deductible on your income tax return. Well, that's just great that you can do that. So it's not about what's right. Transactions can be right, fee for service can be right, all sorts of things can be right. The point is that you need to know what those fees are.
Mm-hmm. Okay. This is This could take the rest of the night if we wanted to talk about it. I know when I was in the business, everybody was looking at the last 5 years of any investment they were looking at and attracted on that basis. And you didn't have to dig very far to find out that that wasn't a good way to go. How do you look at it? Do you look at past returns? Paul, start us off.
I'm going back to a point that you said that often the best advisors could be described as boring.
Didn't mean that as a slight at you.
Yeah, well, and I have this here. There's the better way, and in my 18 years in the business, I think of my training class of 22 people, I might be the only one still in the business.
Are you the most boring of them all?
Apparently. But there's something really to be said for the best examples of how to invest over time are really stories that go around getting rich slowly, not getting rich quickly, because often that tends to lose money quickly as well. So I've always had the philosophy of, slowly doing it in the right way that's worked for 100 years instead of trying to fast forward the process. Mm-hmm. Specifically, well, here's an interesting chart. I mean, there's different ways to go about achieving your investment returns. You can do it on your own, you can do it online, and we'll talk about this robo-advisor element, which is kind of a combination. But does there look like there's any real trend to that chart whatsoever? Greg? Not really. And the truth is, yeah, that's a listing of all the major investment assets and the top performer to the bottom performer over those years. And there's another chart that's more up to date in your packages. But you can't, as Terry said, know exactly what the best performing asset is going to be in the following year. So what you want is go back to a plan that works for you, that has an element of a target rate of return that's achievable given the current world for interest rates, stock market returns, etc. There's a question out there right now, passive versus active. And passive just means you buy an index. Active is you give it to a manager who's going to try and beat that index on some level. Again, I'll go, in my history in the business, there's a bunch of different ways to do it. You have to find the way that works best for you. In terms of, I have met really good advisors that use passive strategies versus active, and I would say we use a combination of both. But again, it's whatever works best for you. There's a discussion on alpha, and really that just means a very good mutual fund manager will have a good alpha or a positive alpha, which just means over their history, they've been able to get a return over and above their benchmark that they're gauged on. There's a comment about index funds. You can just go buy, in a passive way, any index you want. You can buy the top 60 companies in Canada, the top 500 in the US, etc., just with one stock purchase for $25 online. But how do you know you're buying the right one? You could buy the right one this year, that's the wrong one next year, etc. And unfortunately, our business, or not our business, but the financial world in general has a habit of making things more complicated. So there's ETFs that might be regarded as passive, that you want to buy oil, and so now you can get them 3 times leverage to oil. So God forbid somebody happened to buy that last December and would effectively have zero today. And so that, it's almost too easy now to be out there making decisions on your own, because sometimes it's not what it seems. Tax efficiency, you always want to make sure that you're not just talking about your return, you're talking about your return after fees and after tax, depending on where that asset is held. One more point about index funds, and one of the, and we haven't mentioned his name yet, but everyone always seems to bring his name up, Warren Buffett. He's probably the best, he's had the best alpha, so he's been the best fund manager in terms of providing an above average return better than the market for going on 50-some years now. And he's out there really saying the average investor should just go buy an index fund. Just buy the biggest index. So in the US, not the biggest, but the most well-known is the S&P 500. And everyone says, well, why would he do that if he's not actually doing that himself? He knows that he has the emotional and the experience to get through the ups and downs of the market and take advantage of it. He's telling the average individual to buy the index and hopefully don't think about it so that you don't make those decisions when the market goes down to sell low and then buy again high. So it's really in an effort to sort of protect the average investor from themselves, and because the studies are out there that you could have a great mutual fund performance, but the unfortunate part is investors get monthly statements where they buy and sell at the wrong times, and their actual return that they've received is much lower than the actual return of the fund if they would have just held it and forgot about it. So there really is an emotional or a counseling or a stewardship that has to happen between an advisor and a client.
Yeah.
Vic?
So interestingly, when we talk about the passive versus the active, and if I look back over the last 20 years, I will drive by a bank, and in the big giant window of the bank, whichever bank it is, they have a huge poster, and it's highlighted 24.9% one-year rate of return in the Japan fund. And that was the year before Japan crashed and burned to the ground. 56.2% rate of return in precious metals, right before gold, went completely south the next day. Or you should buy Nortel because it's $124.55 a share, and 12 months later it's trading for 11 cents. But between the media and this and that and this wonderful chart, which is exactly saying the same thing, people get so excited about the now and this is what it did last year, let me get in on it so I can now make my 56%. And there's this big giant box in anything you'll ever read from any advisor, and it says, past performance is not indicative of future returns. And why do they say that? Because it's true. That's not a cover your ass situation. That is absolutely a fact that you cannot base all of your decisions simply on what happened last month, last year. We're taking a much, much longer time frame. And in looking at that and so forth, past performance, while the last year doesn't count so much, but it does matter to an extent. It's a measuring stick when we're looking out over 5, 10, 20, 30 years. Paul had referenced, we both sit on this committee for London Community Foundation here. There's $60 million that we have to look after for our community. And we're talking about managing that money way beyond our lifetime and the lifetime of everybody in this room here. We're talking about the next 100 plus years. So the time horizon that we're thinking about when we're talking about retirement for many of you, if we take a median age, let's say of 55 years of age, and we talk about life expectancy being 85, 88, 95, there'll be a lot of people that are going to hit their 100th birthday in this room. And if we're talking about that, your retirement date is not 5 or 10 years as you get to 65. Your retirement right now is 35 years out, still, managing that money. So looking at all things, we say that. Another big giant thing is, believe it or not, and there was a gentleman that won, I'm forgetting his name. He won a Nobel Prize for coming up with this mathematical equation and theory that 90% of all the rate of return you're going to get comes from the asset allocation that you create and not from what specific stock or bond you pick.
Was that Markowitz?
Yes.
Markowitz.
Markowitz, yes, Markowitz, and deservedly so. And it seems almost unimaginable that 90% of your performance will come from that. There's another interesting stat that the Globe had put out last year, and it talked about 69% of all the total return on the TSX and the Dow came from dividends. 69%. Every day when you wake up in the morning, just to own particular dividend-paying stocks, you're almost 70% of the way there to your total rate of return that you're targeting, just to own it. So it tells us a lot about different boring ways of investing, and Warren Buffett is a big, giant proponent of that dividend way of investing, and if it works for you, great, but understand all the differences as you go along, and you don't have to take massive risk to hit your target.
So Terry, Give us
You
your
know,
2 cents
I
about
just don't wanna
insurance.
bore ya. I don't.
No, this is a
But
good thing.
insurance people are usually very boring on what they do. So I think in the effort of time, I'm going to pass this one and pass it over to what we do with regards to the investment advisors. And I think that's probably the best thing.
Okay, about retirement. Well, this is a good question. How do I know if I'm really ready for retirement? This comes down to a financial planning discussion with your advisor, and I'm just going to turn it straight over to Vic.
So we're going to talk about just one clear difference between investment planning and financial planning. Investment planning is taking your actual portfolio, breaking it down between, again, the asset classes, the geographies. Do I have gold, precious metal, bank stock, Berkshire Hathaway, GIC, and pork bellies? Like, all of that is, again, an investment discussion that revolves around specifically how you're doing. Financial planning is much more holistic, right? So now it's, I have a mortgage. How many more years do I have before it pays off? Should I accelerate the payments? Should I pull it out of my corporation in order to do that? How do the taxes fit in? What am I leaving behind to my children? All of those things that help guide us today and into that, I might live 35 more years. Do I have enough money to not just get to retirement, but comfortably get a lifestyle that I'd like to live? So that's a major difference between financial plan and investment planning. There's software that you can use. There's lots of cool tools. You can go online and use them. All of us use different pieces and tools and so forth. And some of them will be 40, 50, 60, 80-page documents. And they're wonderful. And if you want that, certainly you can create those or have them created. But the best financial plan that you could ever have is the one that you understand.
Can I interject about software?
Yeah.
I've been teaching for 5.5 years from now, and my students, I don't think were ever allowed to use software, and that's because we saw such terrible advice come out after using a software package. Because if you don't really understand what the inputs are doing and what they mean as you put them in, you can come out with some pretty awful stuff that you don't understand is wrong. So I think the software packages online are a bit dangerous, and if you ever do them, make sure you go and sit down with a qualified advisor and go through the results and make sure you really do understand it. Yeah.
So just some of the financial software that we pay a lot of money for in this office in order to be able to do some good forecasting. One of the ones that we use just out of interest is called Razor, and the reason that I like it is that if I have to determine what risk issues you may face, either you're going to, what happens if you die now, what happens if you're disabled now, and what happens if you live too long. I've got to look at all those things, and to be able to do so, I have to get a snapshot of where you're at. And so I just gave an example of one type of financing tool that I use where I can actually look at your net worth. And if you look at the bottom line at the very bottom, I don't know if this is going to work, right here, I can tell, a net worth, and this is just an example I used, I made it up. This person has a net worth of $354,000. They're saying that they're saving about $19,000 a year. So I want to know, this one's 45, I had them retiring at 60. They thought maybe they'd like to retire at 60. What are they going to have when they retire at 60? It gives me an idea. And then they tell me the type of income that they want during retirement, and I factor that in, and I get an idea about what there's going to be at the end. And so that gives me an idea about where this person is at. And obviously you can tell that this is not a normal type of financial plan that we would do with somebody. But the thing is that it gives that snapshot, and then you can start that discussion about what it is that you need to be worried about or not worried about. And so when we go to it, what I really like about this kind of software, and we can really play a lot with it, is it'll tell me, it'll say, okay, you can live at, you can actually retire at age 60, you're not going to have any problems. And in this example, this person wanted to retire at an income of $56,000 a year, but it'll also tell me how much leeway I've got. So if this person has a health problem, do we have enough money left over? If we got some extra funds in case they have a health problem, what do we need to do with that? And in this case, there's a little bit of extra funds, not a whole lot, so it would probably mean that we need to have some more insurance. But what it also shows me is what rate of return should they actually be thinking about. In this situation, the person in this example said, well, I think I'm going to get a 5% rate of return. And in order for that person to be able to retire, they can probably handle a 5% rate of return. So that means if you want to go into fixed income and have a 2% rate of return, you're going to have to save a whole lot more money. Or if you're going to go and decide that you're going to always try to strive for 10% rate of return, well, you better make sure you're in the right kinds of investments. So what we do with these kinds of software, and sometimes I'll produce programs that are just 5 pages long, and some of them, as Vic said, could be 20 pages long, is it gives us an analysis of where you're at, or a picture of where you're at, and then it can help us determine where you're going to be in the future, and then that also helps us determine where the investments should be. Now that would be the job of Vic and Paul to determine the investments, but sometimes, you know, I may say to somebody, well, what have you got in your investments? And for the most part, if there are people like Vic and Paul who do really good job of investing, you know, I feel very comfortable with the type of investments. But sometimes I may see some pretty interesting things, and I might say to somebody, well, you know, you're 65 years old, we're on the cuffs, and what are you doing with BlackBerry options? Or what are you doing with leveraged oil? Or that kind of thing. And so that would be the extent of the questions that I would start asking. It would just be probing questions that they can go back to on their advisor, which helps.
And in our experience, we've found that the investment side of things takes so much time that doing a full financial plan can take 20 to 30 hours for, you know, a high net worth individual. So we actually contract that out to somebody within the firm that sort of does that specifically. But it is powerful because it will generate that target rate of return, and hopefully it's not 10%, or else
A lot of pressure.
Yeah, we have some issues, but it generates that target rate of return, so when the market inevitably disappoints us, we can say, well, it doesn't affect your long-term objectives. Everyone's going to school, you're still going to be able to retire, et cetera, et cetera. So let's get back to, you know, the long-term plan.
So through the evening, we've heard lots of things you can do yourself online. You can go buy ETFs, you can make up your own portfolio, you can follow the Motley Fool, and you can do your own retirement projection. So you're going to get a statement showing you a big bill you're paying to your advisor. Why do you want an advisor?
Yeah, and even though we think we've been operating in a CRM2 sort of model for a long time, and we have this benefit sheet, we call it, which details the fees, and it's very hard to actually calculate all the fees because there might be something from a GIC, something from a mutual fund, something from an ETF. So once a year we do this big analysis, and a big part of, as we've developed this sheet, is the behavioral side. And you don't want to necessarily put it in there, but we keep you from doing things that you shouldn't be doing. And that's a big part of what an advisor does, because I mean, we've heard some horror stories sort of things, and unfortunately that's more common than we would like. And there's a term out there right now called robo-advisor, and really it's not a very good term, but what it refers to is the fact that now you can go online and not just get a $25 transaction cost from a discount broker. You can actually go to different groups who will not only do that transaction, but they'll pop up and they'll do a chat with you. Okay, let's do your risk profile. And you fill out some questions, and they would be similar to the questions that we would generate some sort of risk assessment on, but then they have model portfolios and that sort of thing. So you're kind of getting a bit of the advice and the behavioral side, but you're still not getting the same thing. That person, we've actually tested it and opened up accounts. We're not sure that that's a real person or an algorithm where they have certain answers to certain questions. And
Like Siri?
yes, Siri on steroids. But so there is options out there, but I still think it comes down to what are you trying to achieve, and if you're trying to achieve a reasonable return with reasonable risk, with reasonable tax, with a relatively low cost, you can't get that all from a computer or any kind of one scenario. So a big part of it is behavioral. Another thing is, and we talked about Warren Buffett, but his partner, Charlie Munger, is referred to often less, but I think in a lot of ways he says some of the more insightful things. And one thing he says is that every investor should treat their investing career as if they have 20 punches in a card. So every decision you make, you have to make carefully, because then you're only down to 19 left for your career. So what you have to do is think really hard about how you're making those decisions, who you're making them with, and make sure that you're not sort of burning them in terms of wasting them. So a big part is the emotional issues. With our team, we've always been against voicemail. So you will call between 7:30 when one member of our team gets there till 7:30 when Matt's going to leave. He doesn't know that. But so you don't get that voicemail, and you just can't get that from all sources of investment advice. There's a huge issue around tax reporting, and a lot of times we get calls from the accountants. Hopefully we're communicating with the accountants directly on behalf of clients to give them the information they need, but I'm positive that there's a whole lot of tax reporting that's not being done correctly on behalf of clients. So there's a lot of little things as well on top of the, did you get a good return? Were you in the latest, greatest performing holding?
So what I put in everybody's folder there is the 10 Commandments of Investing, and that's from Investopedia, another very good source of information online. And I just leave that with you. A lot of things have already been said tonight, but a very, very good article.
Okay. Well, let's have a few comments or questions from your group here. You had your hand.
Yes, I do have a question. I was talking about financial planner. Is there any licensing? You know, in other professions, you have a license. Say, if you want to be a doctor, then you have the license. So financial advisor, is there any license?
For a planner. There's no legal requirement to have a license. So you have to be aware that anybody can still say that they are a financial advisor. However, I think that if you were looking for a financial planner, anyone who doesn't have their CFP, Certified Financial Planner, by this time, I would say is not serious. Is that fair?
If you're getting a financial plan, for sure, if you're trying to determine the right amount that you need over a certain amount of time, definitely you want to deal with somebody with the CFP.
And I would say also, you want someone with some experience. I was thinking as I came in here, how much does experience matter? Because I know what kind of people are going in there first off. How many of you, I've got 1, 2, 3, how many students in here? How many of you would take your own advice, knowing what you know now in the first year of operating? No, thank you, thank you. And I love you, but I would not take your advice either. Don't go to someone with no advice. Go to someone with experience, who's been through some market ups and downs, or at least someone who's going, I tell my students, you know, you're going to have to find clients when you have no experience. So you just better work triple hard for every one of them. Look up every little thing, make sure you're doubly, and refer to the senior people around you to make sure you're on the right track. It's painful. You will find clients who trust you because they know you're sincere, but they also know to take a lot with a grain of salt in the early years. That's just a problem. So you need someone with experience who's doing the courses. It's not, you don't learn it all just through experience. You need someone who's building their own credentials.
What I did is I put in your portfolio a very big document. It's actually one that Great-West Life sent out to advisors. I think you'll find it very interesting. So I'm just going to refer you to page 11. Now this is for all of you people that lived in the times of the high interest rates, and your kids can't believe that interest rates were ever above, 3 or 4%. So that chart looks at from January 1964 to December 2013, the Bank of Canada rate over that period of time, the average was 6.6%. The average was 6.6%. So it's good to show some young people about what interest rates actually were. So if you go to the next page on page 12, it actually has the Canadian Chartered Bank conventional mortgage 5-year rate. And over that same period of, it's from December 1980 to December 2013, it was 9.16%. Now there's many of us in this room that would have said at one point in time that was considered to be a really good mortgage rate, right? When if you had one in the early 80s. But right now you would die if you ever had something like that.
I locked in 14 3/4 for 4 years.
And you were
I just was scared it could go back up to where it had been.
Yeah. And now what I really love though is right now we're all, we're not all worried, but the news is all about our Canadian dollar. You know, the thing has gone terrible. So let's look at page 13. And since January of 1993, what has been the average exchange rate? 81 cents. We've been there before. We've been doing that. And if you go through this document, you're going to find all sorts of really interesting pieces of information, historical information, that shows the ups and downs of what's actually happened. And in that chart, or in that piece, you'll also find the chart that Paul referred to that actually shows what indices did the best in what year and what did the worst in what all year. And as you know, it's actually a pretty picture. You can put it on your wall. It's very colorful. You don't have blobs in any one section. It's all over the map. So enjoy that piece. I think you'll find a lot of interesting pieces, information in there.
Any other questions?
What are lifestyle deficiencies? You showed it in the one.
I can't get it out of there. Don't look at it.
Lifestyle efficiencies.
I have a couple lifestyle.
Yeah, that program, it actually works out the amount of insurance that you're supposed to get. This refers back to inputs that you can't change. And I do insurance planning all the time, and I look at that and I go, you got to be kidding. It actually tells you to buy way more insurance than what I would ever tell you to buy. And so that they say, okay, you need all this life insurance, you need all this disability insurance or critical illness. I look at it and say, no, you don't. So that's just one of those things that you talk about. We have to analyze these software systems, and some things we can take out, but some things we can't. So if you get it from me, it's usually got a great big cross through all that.
And you really do need someone who takes some care. I had a friend come to me and ask me to refer them to a financial planner, which I did hesitantly because you don't like to take on the responsibility for who they go with. Anyway, this person wrote a financial plan for them, and it was beautiful, beautiful to look at. But it told them they could not retire, not pretty well ever. And the person who her husband, he wasn't anything to do with financial stuff, but he was a smart guy. And he started to go through and plod through line by line by line by line. And he found a very serious input error, which threw off the entire report, and nobody picked it up. So you really need to read with understanding and review everything. And I would say the education part, advisor with client, the education part is very important. Because by the time your client's retiring, you really hope they understand the decisions that they're making.
It's such a trusted relationship, you know, like again, for all of you that maybe don't have an advisor or you do have an advisor relationship, I mean, if you don't 100% trust and have complete faith in whoever you're working with, walk away, like immediately, like look for something else. I mean, because you're in such a position, and I don't want to use the word vulnerability, but that person really should be intimately involved in your financial life and maybe to some extent even in some of the personal decisions and goals that you have. I mean, they really should be a part of your team in your life. So
it's also a two-way trust. You know what a fun seminar would be is how to be a good client.
yeah.
Because the trust has to go both ways, and I wouldn't hesitate to tell my students, you know, there's some clients you should walk away from. And people in business do. I see some head nodding go, it would be a fun seminar.
Some clients just need to be fired.
Yeah. Any other questions from anybody? Well, why don't we just move around and chit-chat? I know some of you will want to leave, but
Yes,
if
I
nobody
wanted
has
to
any.
say, thank you to Lynn for
Well, this is
all of
fun.
her work and coming here tonight. she's an icon in my life, that's for sure, and been around for so long. We've had such a great relationship, and I'm so
Stop putting it that way.
I'm so thrilled to have her with us today.
It's fun for me.
I want to thank my fellow panelists, both Vic and Paul, who agreed to talk very openly and candidly, and they're going to be here for any question that you have afterwards. I would also like to just introduce some of the people in the room that you probably already know. Samantha, you're here, right? There, we got Camilla there, Grace from Jindal Financial, Sam's with Zavitz Insurance, and Justine. Everybody knows Justine, right? And my little granddaughter that's going to be born anytime.
Really?
Yeah, we're waiting patiently. No, we're not. Anyways, I want to thank you for coming and taking the time. It means that you really care. And please enjoy cookies, coffee, and conversation. And I sound like we're ending church, but yeah.
Except for the wine.
Yeah,